Hi everyone, Greg Martin, the Entrepreneur's Banker here. And this week we're going to talk about something that a lot of entrepreneurs really don't spend a whole lot of time planning out and budgeting. It's their capital expenditures or their CAPEX. Now, capital expenditures are things like vehicles and equipment that are not inventory because you need them in your business, but they typically have a longer useful life than more than just 1 year. It's not just I'm going to use it for this one job and then I'm going to discard it. I'm going to keep it in my business. I'm going to use it in my business in order to sustain operations. I've got a client that really started to do some pretty intense CAPEX planning in the last 3 years, and it has significantly helped them to achieve goals as they were stretching operationally. They're actually looking to expand their service area geographically, and knowing that they were going to have to acquire new vehicles and equipment to do that, it was critical. But they couldn't go out and buy a whole new fleet of vehicles and a whole bunch of equipment because their business it constantly is churning over and they're having to replace equipment every single year. So it was more of a gradual plan. So I want to go through this plan with you and to be able to just kind of walk through something that I coached them with, but then also some things that I learned from them as we're going through the CAPEX plan. The purpose of a good capital expenditure plan is critical to your business. The purpose of the plan is to provide you and your company a framework to have and maintain vehicles and equipment, large capital expenditures. One could say that real estate may be involved in this, but I'm not really going to dive too much into that because that's a little bit different type of analysis. But this is really to be able to help your business have the vehicles and equipment that is needed, not only for sustained operations, but for future operations. And we're going to kind of break this up into 4 different areas today. First off, we're going to do just that. We're going to look at sustained operations and how do you identify what is needed for sustained operations, and then what do you need in order for future or growth operations, and can you use some of the equipment that you're using for sustained operations? Does it have capacity in order to help support the new growth, or do you just need to get new equipment? 2, we're actually going to take a look at the balance between repairing equipment and buying new equipment. Obviously, every time some of your equipment breaks, it's cheaper and more reasonable to just repair it instead of going out and buying a new truck every time the oil needs to get changed. And so knowing that there is going to be a repair and a maintenance schedule, but there comes a point in time where what needs to be repaired costs more than what the vehicle or the piece of equipment is actually worth because it's obsolete or it's so well damaged or so well used up. And then being able to know the balance between when do you repair and when do you replace. 3, we're going to look at the total cost of acquiring equipment, because the total cost is not just the sticker cost that's on the window when you're buying it. And 4, we're going to talk about the actual acquisition strategy. Does it make sense to pay cash for this type of equipment or to finance it? And when you're financing it, to be able to consider how do you get the best structure and what helps you from a strategic advantage and a strategic capability, but not putting you behind the 8 ball when it comes to payments or loan structure. The outcome that I want your company to have is to have an actionable plan that allows you and your company to acquire large purchase assets in the right time and the most strategic way. This will impact your business in a lot of different ways. 1, it will keep your sustained operations or even your growth from stalling due to equipment bottlenecks or downtime. 2, it'll actually increase your profits, as having unnecessary expenses such as higher than normal repair bills, having to pay for overtime, renting equipment, or maybe even having to outsource the job completely, these are eliminated. 3, this will keep you from taking on too much debt or having an inflexible debt structure. This actually will strangle your future cash flows or overcommit your future earnings. And the 4th and final way that it'll impact your business is it will actually increase the impact that the capital assets have on your business by preventing you from having to make I need to have this equipment right now, this type decision, which if you need to have it right now, it may mean that you settle for less than the preferred asset. So let's talk about the actual system that you can use in order to develop your CAPEX plan. And the system is really simple. It's just asking yourself some pretty intuitive but direct questions when it comes to your capital expenditure, your capital assets. So let's dive into the first one, and let's talk about how you're going to analyze and the questions that you're going to ask for sustained operations and future growth operations. So for sustained operations, obviously you ask, what equipment is needed? Do I have it on hand? What's the useful life of that equipment? If that equipment has to be replaced, let's say it's at the end of its useful life, then what is the cost, and what would be the new useful life of that new equipment or the replacement equipment? Knowing that you're going to have a maintenance plan in there in order to make sure that it's maintained and that useful life is made as long as it possibly can be. Another thing to consider is there specific equipment or maybe even components of equipment that are critical to your operations? I had a manufacturing client one time tell me that his job, one of his lines was shut down for 2 days because of a $750 flash drive. Well, you can be guaranteed that the first time that happened and went down for 2 days, that he didn't just order one replacement. No, he ordered 2 or 3 replacements and made sure that he had those on hand. And then the last question to ask when you're talking about sustained operations and your equipment is what is the normal wear and tear on them, and are you planning on having those expenses in your operational budget? So that's for sustained operations, or what you're normally doing. But future operations, future growth operations require a little bit different questions to be asked. So obviously it's going to start off the same thing: what equipment is needed? And if we have it already, do we have the capacity in our current equipment in order to meet our future growth obligations? And if we do have the equipment and we have the capacity, how will using it more often impact its useful life? Obviously, it will shrink the useful life, but can you counteract that some way through an aggressive maintenance plan or by a refurbishment plan, something like that? If you don't have the equipment and you're going to have to acquire it, then you ask, okay, so if we acquire this new piece of equipment, how is that going to fit into our current operations? Is this a specialized piece of equipment that I can only use it on one particular job, or does it actually increase capacity, maybe efficiency or capabilities throughout the entire operation? Where does it fit into your workflow? If you've got a manufacturing plan and it's all laid out, and you're going to have to actually get an electrician in there and move some different pieces of equipment around in order to increase your workflow, to reduce a bottleneck, to be as lean and mean as possible, then you need to take that into consideration. And then also you need to take into consideration this new equipment. How obsolete is it going to be? You don't want to necessarily buy some equipment and then have it be obsolete 12 months later, or either through what you're doing with it, or through your growth cycle. So you may want to strategically think about what you actually buy, and maybe buying something that's got more capacity than what you need right now, but it's something that will grow with you as your business grows. And then finally, if you're having to acquire, you got to ask yourself how you're going to acquire it and how are you going to pay for it. And we're going to talk about those in just a second. At some point, it becomes more cost effective to buy new equipment than to continue to maintain and repair the old equipment. And so you've got to just do an assessment to say, okay, how much is this costing me every single year in order to maintain? But the one thing that I'm asking you to think about is that you can't go back historically and say, well, look, it has cost me X, Y, Z in order to maintain the equipment over the last 5 years. That's a sunk cost. That's money that you're not getting back, no matter if you maintain it or you get new equipment. So you have to be forward looking when you're doing your analysis between repair costs and acquisition costs, and just eliminate everything that happened in the past. So let's talk about the third part of the strategic CAPEX plan, and that's actually taking into account the entire cost of your purchase. It's not just the price of the vehicle, it's not just the price of the equipment, but is what I call the 3 T's. You've got your taxes, because for most businesses, unless you're not for profit, most businesses have to pay tax on it. So for some large piece of equipment, that could be a pretty hefty bill. You got to worry about transportation costs, and actually, is this something that's got to be moved from one place to the next, or you just go to the car lot, get somebody in it, and then drive it and put it into operations immediately. And 3 is training, and to be able to say, okay, depending on the type of equipment, you may have some costs that with bringing some people as some expert down in order to do some training, not only from the operational standpoint, but also if you got a maintenance crew, to be able to make sure that your maintenance crew knows how to maintain this thing properly. Another thing to consider when you're thinking about total costs is your maintenance and your repairs costs. And I'm not just talking about the cost to actually do the maintenance and the repair, but I mean, think about how often this has to go offline in order to do preventative maintenance. It's because if it's not online, then obviously it's not generating services or goods in order for you to sell. What is the availability of these parts if something does go wrong? So imagine that you're in America and you have a German-made machine, and every time it has to be any type of replacement, you have to have that plan in advance, because it takes 1 or 2 weeks in order to ship it over from Germany. Well, you need to know what those critical parts are. You need to know what parts are most likely to break are, and make sure that you've got an inventory on hand. That inventory, it is going to cost you money, and so you've got to be able to have that baked into the whole plan. And then what about for some types of equipment or some vehicles? If a vehicle were to go in a shop, well, it's easy enough for you to get a loaner and to be able to continue operations and do what you need to do, but not all equipment is like that. But if you know that you've got a source that you can acquire or rent or borrow a replacement vehicle, then that replacement part or piece of equipment, then that's something that needs to go in your plan, and that's obviously a benefit. Not all costs associated with equipment and vehicles are negative. They can be positive. If you get a new piece of equipment that increases your efficiency, and you're able to maybe do the same operations with 25 less people, you can redeploy those people into a different area of your business, well, then that's a positive thing. So looking at efficiencies and the cost benefits that you'll get is also a critical part of your CAPEX plan. Finally, when you're looking at the total cost of that piece of equipment or vehicle or whatever, I mean, think about how much of a lead time you need in order to actually acquire it. Is this a specialty piece of equipment that's going to be manufactured specifically for you? And if so, it's going to take 6 months in order to do that. Well, that's obviously not something that you can make a snap decision and replace and just, willy-nilly. You're going to have to plan that out, and having a CAPEX plan that takes those types of costs into consideration. How available, how quickly can you get a replacement or a new piece of equipment? Having a CAPEX plan that looks at everything is going to help empower you and help your business. And lastly, let's talk about the acquisition plan of your CAPEX plan. And what I mean by this is, how are you actually going to acquire it? Because vehicles and equipment are acquired 1 or 2 ways. You either buy it outright in cash, or you finance it. And if you buy it outright in cash, that's fine. So you have no debt, and that makes you very flexible, because you're not committing future cash flow payments in order to pay for this piece of equipment. But you're reducing your flexibility by having cash go out the door. And so you don't want to use cash that's needed for current or future operations, your working capital, to be used to acquire capital expenditures. And think about that. Your working capital helps your day-to-day operations in this year. This CAPEX purchase that you're going to have it for years to come, so you can spread the cost of acquiring that out over years. Put another way, don't use today's cash to buy an asset that will be here for today, tomorrow, and the next day. if you are going to finance any type of capital expenditure, here's a couple things that I want you to think about. First and foremost, it's all about financial flexibility, or having the ability to shift, pivot, grow, or to react to whatever's going on in your business. And so you can have a strategic debt structure that supports that. You do this, one, by getting the longest amortization that you possibly can. Now, you're not going to exceed the useful life of the piece of equipment. Like, you're not going to get a vehicle loan for 30 years, because after 6, 7, 8 years, your vehicle will be used up, but you'll still owe 90% or probably closer to 80% of what's owed on that. And then you're going to trade it in, you're going to be underwater. So you don't want to go beyond the useful life, but you want to get as long as amortization as you can. You want to pay it down aggressively as you can to get out of debt as quick as you possibly can. But you want to be able to be smart about it. Again, if you do have debt, you want to pay it off early. It's the old Dave Ramsey debt snowball. So once you pay one loan off, take whatever you're used to paying on that loan and apply it to the next one until that one's paid off, and then take what you're paying on those two and do it to the next one. So you're getting out of debt as quick as you can. But as you're doing this, I'd also ask you to consider maybe a CAPEX snowball way of looking at it. In the sense is once you've paid this loan off, instead of going and if you have other debt, you can eliminate that debt. But if you don't, then keep paying that money and start putting it into a savings account. And that's going to be your CAPEX account. And so that every year you have cash that's set aside that you can put to purchasing new capital expenditures, and you're not having to finance 100%. Ideally, you'll get to the point that you as an owner are able to sustain your CAPEX expenditures with zero debt. And what that does is that takes whatever interest you've got, even if it's 2 or 3% interest a year. Well, that's 2 or 3% interest a year that can go to your bottom line. They can go out as a distribution to you as the owner, all because you had a disciplined CAPEX plan and you're working the system. A lot of equipment purchases out there offer very attractive rates, and so it's all about financial flexibility. And ideally, having no debt is preferred to having debt. But there are some deals that they offer 0% financing for X amount of months or anything, and that's really good. But make sure that you're actually looking at it and looking at different options, because what I've seen sometimes happen, this doesn't happen on all of them, but what I've seen sometimes is that the dealer will actually increase the cost of purchase by $2,000 or $3,000, $3,000, $4,000, $5,000. And that's, in essence, they're just rolling that interest into what you're paying versus having conventional financing and getting it out the door at a cheaper price. Another mechanism that you can use when you're looking at financing is what I've seen termed as a guidance line of credit. Think about this as, so you've got a working capital line of credit that you can draw on in order to pay for working capital, pay for inventory or something like that in the short-term working capital needs. Well, a guidance line of credit is a similar thing for your capital expenditures. Let's say that you have a $1 million guidance line of credit, and so basically what that means is that you're pre-approved for $1 million, and that once you get an invoice from somebody that you're buying some equipment from, you give it to your banker, and the banker's going to turn around and going to say, okay, in a couple days I'll have a promissory note, and it's going to be a 5-year note, and this will be the fee, and this will be the rate. Sometimes they'll lock the rate in for the whole term of the guidance line. Sometimes they'll say, okay, it's prime plus 0, or whatever the fixed rate is at that time. So asking your banker if you can get basically pre-approved for equipment purchases for the next year, or having a guidance line of credit, at the very least you know that you've got one financing source available. And if the dealer offers a better deal than what your bank offers, well, then you take that. But at the very least, you're negotiating from a position of strength.
Okay, so really, as you can tell, the system for your CAPEX plan is really just an honest assessment of what your current operations are, what your future plans are, and then what does it take from a capital expenditure, a vehicle and equipment standpoint in order to support those. Where are your risks and where are some potential fatal flaws that would hurt you and hurt your growth? So what I want you to do now is, as you are going through and filling out your capital expenditures planning sheet, again, this is in the CAPEX planning exercise tab on the planning workbook. If you don't have this workbook, then please send me an email or a DM. I'd be more than happy to send this to you. But what I want you to do in this exercise, this is both immediate and long-term. In the immediate exercise, I want you to go through and I want you to just simply go and list all of your specific assets that you have that you need in your business. And then based upon your experience, based upon the input from your people, you can say, okay, this is how much remaining life I've got in each and every single one of these assets. So if I've had a truck and I've had it for 10 years, then it might only have 1 or 2 more years to go. If I've had a backhoe and I've only had for 6 months, well, maybe that's something that's going to last me 7, 8, 9 years, depending on how much you use it. Same thing for your phone, everything from your phone system to your computer, stuff like that. And once you understand what the remaining life is, then you've got a pretty good idea of the approximate date that you're going to have to replace it. So again, part of this plan is looking forward into the future and saying and planning for that replacement or planning for that growth and having the equipment needed in order to sustain that growth. And then last thing I want you to do in the near-term exercise is I want you to assess yes or no. Is this piece of equipment a critical piece of equipment, or does it have a critical component? Remember, I talked about my manufacturing client that was down for 2 days because of a $750 flash drive. Now, I can guarantee you that he lost a lot more than $750 a day because his manufacturing line was down. So that was a critical component. And the way that I would describe a critical piece of equipment or a critical component is that if it goes down, or if it goes in the shop, or it just completely breaks and you have to repair it, that you all operations stop. You don't have a workaround. You don't have a way to quickly get back up to full capacity. And so once you've done that and you've got a good idea of the equipment, the remaining life, and when you're going to replace it, and if it's critical, then you can just simply rank order all of the assets and to be able to say, okay, make sure that I've got a plan in place to be able to replace those. And then once you've got that in the critical order, you can start saying, well, how much is it going to cost me to replace it? And again, remember, your cost is not just the sticker price that is on the piece of equipment. You've got the tax, transportation, training, all rolled up. And so having a good idea and being prepared for that. And then the tool that I built in here on this sheet is to really just give you just a really rough estimate about what it would take if you had to have a loan in order to obtain that piece of equipment. So let's just look here. Let's just say that, let's imagine that it was a $400,000 piece of equipment. And you think that, you went out and you talked to the dealer and they've got some really good financing right now, and then say it's a 1.99% loan, and that's going to be a 5-year loan. Well, then that piece of equipment is going to cost you about $11,500 a month. So as you're going through, remember we talked about the income plan and your cash flow plan. Understanding, do you have the excess capacity every single month in order to have an $11,500 payment? And if you don't, then you need to start working around either finding a cheaper piece of equipment, finding an alternative, saving up cash. So instead of maybe a $400,000 piece of equipment, maybe you save up $100,000 and you actually finance $300,000. And so instead of having an $11,500 payment, if you saved up $100,000, then your payment's only going to be $8,600. So as you're going through this is just a tool for you to understand and a tool for you to use in order to determine your future capital expenditure plan.
So that's going to wrap it up for today's lesson. But I hope that you got a lot out of this, because I think capital expenditure planning is something that a lot of entrepreneurs know they need to do, but didn't necessarily have a framework to do it, or they just kind of just went about it willy-nilly and said, okay, once something breaks and it costs more than it's worth to repair it, then I'll buy something new. But actually having a plan in place to be able to extend the life of your capital assets and to have a plan to acquire or maintain them is going to help you and your business achieve your long-term goals more than you know. And I'm excited to be able to share that with you. So here's what I'm asking. If this meant anything to you at all, I would love to, this is just a tool that I've used and developed, but if you have a more robust or even a simpler CAPEX plan, I would love to hear it. I'd love to be able to understand what you use in your business to be able to manage and help this type of asset, and to learn from you. And two, if you haven't had a capital expenditure budget or a plan beforehand, if you got any questions, please reach out to me. I'd love to be able to kind of walk through this with you and to be able to ask some further questions that I think are pretty applicable for you and your company. So thank you again so much for listening and being part of this lesson. Make sure that you join us next time when we talk about actually planning out your financial strategic plan to be able to look forward and say, okay, well, I've got long-term growth. Well, how do I match up my finances of that with the long-term growth? Until then, this is Greg Martin, the Entrepreneur's Banker, wishing you happy planning. Thank you.